Hey everyone, and welcome. If you've ever wondered whether you can contribute to both a regular employer 401k and your own solo 401k in the same year, you are in the right place. Today's session will clear up the confusion, show you the rules, and help you avoid costly mistakes. As always, go ahead and shoot over questions during the live webinar. We'll go over those questions as they come in. Again, today's topic is, can I contribute to a 401k and a solo 401k in the same year? And it looks like we've got some questions here on the live chat. So grab your notepad because I'm also going to walk you through a step-by-step example that could save you thousands in taxes. And you won't want to miss that. So let's take a look at some of your questions here, and then we'll come back to today's topic. Again, please subscribe to our YouTube channel so you receive notifications as we go live every day. Oftentimes, we'll go live twice a day, but we go live at least once a day every day, and you can ask questions about any aspect of IRAs, solo 401k plans, also known as individual 401k plans, as well as traditional 401ks, like full-time employer 401ks. Well, here's a question here. Currently, I have a solo 401k at Fidelity. When we open a new solo 401k account with you guys and then cancel it with Fidelity or convert it? Great question. So we get this question quite a bit because we do have a lot of clients that start off with a solo 401k at Fidelity or even Charles Schwab, which is typically a type of solo 401k that restricts you from being able to invest in alternative investments. It doesn't have a checkbook attached to it, nor does it come with the auto contribution credit of $1,500, nor does it allow for solo 401k participant loans. So the answer is yes. We would help you transfer that existing Fidelity solo 401k over to a self-directed solo 401k from my solo 401k financial. And that's known as a restatement. When you change from one existing solo 401k provider to another, that's referred to as a restatement in the industry. And in the eyes of the law, that's the terminology, a restatement. So the way it would work is that first you would complete our online application so that we collect the necessary information to draft those plan documents. Then we would obtain a tax ID number for the 401k because the 401k will have its own separate EIN number. So the self-directed solo 401k offered by my solo 401k financial will have its own EIN number. Then we'll help you open up brokerage accounts at Fidelity for the solo 401k that we offer. Yes, you heard that right. Fidelity Investments will provide brokerage accounts for a solo 401k plan offered by my solo 401k financial because my solo 401k financial is the plan document provider and the one that's going to assist with the ongoing compliance reporting upon your request. Compliance reporting such as Form 1099-R for distributions, conversions, and even Form 5500 Easy, which is an informational return that applies once the market value of your solo 401k plan is greater than $250,000. We take care of those compliance reports at no additional cost for clients who timely request it. So once the new brokerage account is open at Fidelity for the solo 401k offered by my solo 401k financial, we'll help you to move that existing Fidelity solo 401k internally by preparing the applicable transfer form so that any equities, let's say you've got some stocks or exchange traded funds in that existing Fidelity solo 401k, you will not have to liquidate those positions. Those can be picked up and moved over in kind and deposit it into the new brokerage account for the self-directed solo 401k offered by my solo 401k financial. And what's advantageous about a restatement when you switch from a Fidelity solo 401k to a self-directed solo 401k from my solo 401k financial, besides the items I mentioned earlier, that is being able to invest in alternative investments, being able to borrow from the solo 401k plan through a participant loan, also being able to utilize the mega backdoor Roth solo 401k, is that when that existing Fidelity solo 401k is moved over to the new self-directed solo 401k from my solo 401k financial, that's not going to be a reportable event to the government. In other words, it's not going to trigger the issuance of a Form 1099-R or a final Form 5500 easy. Why? Because you're not closing your solo 401k plan. Instead, you're changing providers from Fidelity Investments to my solo 401k financial. So it's not a reportable event, and therefore it's not a taxable event either. So good question. So that's how the restatement works. We also have some good information on our website that talks more about how to restate from an existing Fidelity solo 401k. Let me send that over now. I'm going to share this link so you can look at it. It's called a restatement again. So take a look at that. Here's the link here. How to change from a Fidelity solo 401k to a self-directed solo 401k from my solo 401k financial, for example. Okay, again, today's topic is, can I contribute to a 401k and a solo 401k in the same year? Also, please like our video. Please subscribe to our channel to help get the word out to other solopreneurs like yourself. And go ahead and shoot over questions you have during today's topic, and we'll answer those questions as they come in. Looks like we got a lot of participation today. Let's see who else has a question here. Looks like Alfonso has a follow-up question here. How does the opening conversion of the new solo 401k account affect your ability to make contributions? It's not going to impact it from a negative side of things. It's actually going to be a positive change from a contribution perspective. Why? Because now you're going to be able to make voluntary after-tax solo 401k contributions, which is not allowed under a Fidelity solo 401k or even a Schwab solo 401k. So you're going to be able to do the mega backdoor Roth solo 401k strategy. The contribution limits will still be the same, of course. The contribution limit for tax year 2025, for example, is $70,000. Or if you're age 50 or older, you get an additional $7,500 as a catch-up contribution for a total of $77,500. And then you've got the super catch-up contribution for those who are a certain age. So if you are age 60, 61, 62, or 63, instead of doing the $7,500 catch-up contribution, you can do a super catch-up contribution of $11,250. So you add that to that $70,000 normal contribution figure, and you can contribute as much as $81,250 for tax year 2025 to that solo 401k. So talk about supercharging your retirement account savings. All right, let's see what other questions we have here. Like Alfonso has another question. Can I do current 2025 year contribution, or would I have to wait until next year? No, you can contribute now for 2025 because you already have a solo 401k at Fidelity. Again, that solo 401k at Fidelity is going to get restated to a solo 401k from my solo 401k financial. Therefore, you can contribute for tax year 2025. What is more, if that solo 401k plan was open last year in 2024 or in prior years, and you have not made your 2024 contributions yet, you might be able to still make 2024 contributions to this restated solo 401k through my solo 401k financial. Well, you won't lose any of those contribution benefits. If anything, you're going to gain contribution benefits, as I touched on already. It was like Alfonso has another question here. Does it matter if no contributions have been made in the current plan year? No, it does not matter, because you've got until next year in 2026 to make 2025 contributions. You can make employee and employer contributions as well as voluntary after-tax solo 401k contributions for tax year 2025. Next year in 2026, by your business tax return due date, and if you file a business tax return extension, you're going to have until your tax return due date extension in 2026 to make those 2025 contributions. And that's true for all contribution types, employee and employer, and even voluntary after-tax solo 401k contributions. Okay, so looks like another question here from Paul. If the restatement from the vanilla Fidelity get a new account number, will I have a new bank statements that my solo 401k will provide, or will Fidelity still issue monthly, quarterly statements? So once you transfer from the Fidelity solo 401k through a restatement that will handhold over to a self-directed solo 401k from my solo 401k financial, you're going to have new brokerage accounts at Fidelity for the self-directed solo 401k offered by my solo 401k financial. And again, take a look at that link I sent earlier. So again, let me share this link here. So you will be essentially firing Fidelity and then hiring my solo 401k financial when you move from their solo 401k to a solo 401k from my solo 401k financial. Therefore, since you're going to have new brokerage accounts at Fidelity for the solo 401k offered by my solo 401k financial, you're going to have new account numbers. Why? Because Fidelity will not allow you to use the existing brokerage account for the solo 401k you have with Fidelity. So it's a Fidelity requirement. And then that existing Fidelity solo 401k will be moved over internally to the new brokerage accounts for the solo 401k offered by my solo 401k financial. You're still going to log in through Fidelity to view your accounts, just like you do now. What is more, you're the only one that's going to have access to those brokerage accounts. We're not going to have access to those brokerage accounts. And that's by design, because we don't need to have access to your funds in order to assist you with the plan. So yes, new account numbers. You're going to log in through Fidelity to view those accounts. We do not have access to your funds. So you're going to get account statements from Fidelity, not from my solo 401k financial, because Fidelity will still hold the new solo 401k funds and that new brokerage account for the solo 401k offered by my solo 401k financial. Again, take a look at that link I just sent over as it breaks it down from A through Z. And we've done webinars on this topic in the past. Okay, let's take a look at some questions and then we'll come back and go over some more live questions. Again, please like our video, subscribe to our YouTube channel for more videos like this and to receive notifications. So let's take a look at today's topic, which again is, can I contribute to a 401k and a solo 401k in the same year? The answer is yes, you can. That's the quick answer. So let's break down some of these topics here. Let's talk about how the annual employee contribution limit works across both plans. Both plans being a solo 401k, which is sponsored by your self-employed business. The second one being a traditional 401k, also known as a full-time employer 401k offered by your daytime employer. So one, the annual contribution limit, and let's use tax year 2025 numbers for simplicity. For tax year 2025, the overall contribution limit is $70,000. So that $70,000 overall limit works in a variety of ways, which is impacted by the contribution source types that you want to make. So let's talk about employee contributions. Employee contributions can be made as pre-tax contributions or as Roth contributions. The employee contribution maximum limit for tax year 2025 is $23,500. We'll get into the catch-up amount of $7,500 and $11,250 a little bit later. But for simplicity, let's assume that you are under age 50. Therefore, the maximum 401k contribution, the aggregate amount, known as the 415 overall limit, if we want to get technical here about IRS code sections, that one is $23,500 on the employee side. And then you've got the employer contribution, also known as a profit sharing contribution. That one there has its own set of rules. That one there is, it's typically 20% or 25% of your self-employment income. If we're talking about a sole proprietorship, that's taxed as a sole proprietorship, that's going to be 20% with regards to the employer contribution. If it's an S corporation or an LLC taxed as an S corporation or even a C corporation, then the percentage is 25% of your W-2 wages from that self-employed S corporation. So the employer contribution is always a percentage base. The employee contribution is a dollar for dollar calculation. Then there's the voluntary after-tax solo 401k contribution, which is part of that mega backdoor Roth solo 401k. That one there is a dollar for dollar calculation, just like the employee contribution is a dollar for dollar calculation. So it's not a percentage calculation like the employer contribution is. Okay, now let's talk about let's say that you want to contribute to your solo 401k plan. Let's say it's that the self-employed business is taxed as an S corporation. Let's also assume that you also participate in your daytime employer's 401k. So that means you're going to have two 401ks, one through your daytime employer, and the second one through your self-employed S corporation. As a result, you're going to be able to contribute to both plans, and here's how. So example one, let's say that you maximize your employee contribution to your daytime employer 401k. So you contribute $23,500. That means that if you want to maximize your employee contribution to your solo 401k, you will not be able to. Why? Because employee contributions are aggregated between your solo 401k plan and your daytime employer 401k. However, if you want to make an employer contribution, let's say you also maximize your employer contribution to your daytime employer 401k. So your daytime employer makes a 25% contribution to your daytime employer 401k, let's say $25,000, because you receive $100,000 in W-2 wages from your daytime employer. So 25% of $100,000 is $25,000. So you add that $23,500 that you contributed to your daytime employer 401k as an employee contribution, and then you add the 25%, which is $25,000 of profit sharing contribution made by your employer to that daytime employer 401k. That's what, a total of $48,500. So now you want to contribute to your solo 401k and you want to maximize. And let's say you are looking to maximize pre-tax contributions because you are trying to reduce your taxable income for the year because you are in a high tax bracket. So taking into account that you've already made a $23,500 employee contribution to your daytime employer 401k, and your employer made a 25% profit sharing contribution, and your W-2 wages from that daytime employer are $100,000. Those two amounts, that $48,500, so the $23,500 plus that 25,000, which is 25% of that W-2 wage payment of 100,000 from your daytime employer, which is when added together is $48,500. That means that now when you go to make your solo 401k contribution, you will not be able to make any employee contributions to the solo 401k, because again, employee contributions are always aggregated between your daytime employer 401k and your solo 401k. However, the employer profit sharing contribution is not. So let's say you pay yourself $200,000 of W-2 wages from your self-employed S corporation. You're going to be able to contribute 25% of that $200,000 as an employer contribution to the solo 401k. So 25% of 200,000 is what, $50,000? So you're going to be able to contribute $50,000 as a solo 401k contribution, as an employer profit sharing contribution. And keep in mind that the contributions to a solo 401k plan, they are always going to be based on your net self-employment income. And again, we're using the example of an S corporation self-employed business. So if you're trying to get $50,000 of employer profit sharing contributions to your solo 401k, you're going to have to make at least $200,000 of W-2 wages from that self-employed S corporation, because it's calculated as 25% of that $200,000. Another example, let's say you report $300,000 of W-2 wages from your S corporation. So you multiply that 300,000 times 25%, which is what, $75,000? Well, the overall limit to a solo 401k is $70,000 for tax year 2025. So even though you calculate 25% of 300,000 of S Corp W-2 wages and you get 75,000, you can only put in that $70,000. You can only put in $70,000, because that's the overall limit that you can contribute to the solo 401k plan. So those are things to keep in mind. Now let's do another example here. Let's say you want to utilize the Mega Backdoor Roth Solo 401k plan. Let's keep the same examples I used earlier, where you contribute to your daytime employer 401k. You receive 100,000 of W-2 wages from your daytime employer. You end up maximizing your contributions to that daytime employer. Let's say you do the full 23,500 employee contribution. The daytime employer does that profit sharing contribution of 25%. So now you can contribute a total of $48,500 to that full-time employer 401k. Let's now say that you open a solo 401k for your self-employed business S corporation. Let's say that you pay yourself 100,000 of W-2 wages from your S corporation. You're going to be able to you're going to be able to make a $70,000 voluntary after-tax solo 401k contribution to the solo 401k, because voluntary after-tax solo 401k contributions are not impacted by any contribution that you make or your employer makes to your daytime employer 401k. So that's one of the great advantages about the Mega Backdoor Roth Solo 401k. And that's why we get a lot of doctor clients, attorney clients. We have a lot of anesthesiologist clients, because they tend to be high income earners. Some of them have a daytime employer 401k. They maximize contributions to that full-time employer 401k. Then they open a solo 401k plan, because they also have a side business. So they open up a solo 401k for that side business. And then even though they may have already maximized their daytime employer 401k contributions all the way up to the $70,000 overall limit, they can still do another $70,000 to that solo 401k by treating it as a voluntary after-tax solo 401k contribution. And then they turn around and convert that to the Roth Solo 401k or the Roth IRA. So conceivably, they end up with contributing a total of $140,000 between both plans. So we've been offering the Mega Backdoor Roth Solo 401k. We were actually the first self-directed solo 401k providers in the industry to offer it. We've been offering it since 2013, and we've seen it increase tremendously every year. I mean, last year we saw an 80% increase in the number of clients utilizing the Mega Backdoor Roth Solo 401k strategy. So when it comes to the Mega Backdoor Roth Solo 401k strategy, the takeaway is that it's made up of voluntary after-tax solo 401k contributions, number one. Number two, it's a dollar for dollar calculation. So even if you only pay yourself $70,000 of W-2 wages from your S corporation, you can contribute that entire $70,000 as a voluntary after-tax solo 401k contribution, even if you've already maximized all the contributions to your daytime employer 401k, and then turn around and convert that voluntary after-tax solo 401k contribution as part of the Mega Backdoor Roth Solo 401k strategy to the Roth Solo 401k or the Roth IRA. Okay, let's take a look at some questions here and then we'll pick back up again. Again, please like today's video, subscribe to our YouTube channel for more videos like this. Let's see, we've got a question here from looks like, who is it here? Let me scroll down. Here we go. As a teacher, I can contribute to a 403b and 457 and have an S corp. How can this combo work? I'm under 50. Good question. So even though today's topic is, can I contribute to a 401k and a solo 401k in the same year? And we will do future webinars regarding the 403b as well as the 457b. Let's go ahead and touch on it now. So with the 403b, the aggregation rules are a little quirky. Specifically, they're not as beneficial. So for example, if you contribute to a 403b and then you also have your own self-employed business and open a solo 401k plan, it's not as advantageous from a contribution perspective as it is if it's a full-time employer 401k and then you have a solo 401k. And that's because the 403b regulations put more restrictions. With the 403b, you have to aggregate all of the employee and the employer contributions made to that 403b if you also want to contribute to a solo 401k plan. So for example, let's say you have a 403b through your daytime employer 401k. Let's further assume that you maximize your employee contributions to that 403b plan, so the 23,500. Let's further assume that that employer that offers a 403b also did employer contributions to that 403b. Let's say between the employee contribution that you make to that 403b and that employer contribution to that 403b, you end up contributing a total of $70,000 to that 403b. Well, unfortunately, you would not be able to make any type of contribution to the solo 401k because you have to take into account all of the 403b contributions that you make when contributing to a solo 401k for your self-employed business. So that's a big difference between a full-time employer 401k and a full-time employer 403b from a contribution perspective. That is that you won't be able to maximize your solo 401k contributions. That's also true for the Mega Backdoor Roth Solo 401k strategy. That same example, if you've already maximized the overall limit of $70,000 to your 403b in contributions, even if you have enough net self-employment income in your self-employed business and you want to contribute to your solo 401k, you won't be able to make any voluntary after-tax solo 401k contributions either. So the 403b is not as good as from a contribution perspective when you're trying to really supercharge your retirement account savings by contributing to multiple plans. Now, the 457B one is an interesting one because that one there, that's a governmental governmental plan. That one there is the opposite of a 403B from a contribution perspective. And it's even more advantageous than a traditional 401k from your daytime employer. But the 457B, let's say that you maximize your contributions to that 457B up to the $70,000. That's not going to impact the contributions that you make to your solo 401k if you also are self-employed and open a solo 401k. You're still going to be able to make the full $70,000 in contributions to that solo 401k, provided you have enough earned income from your self-employed business, of course, to justify that contribution. And you can make employee contributions and employer contributions to the solo 401k, as well as the voluntary after-tax solo 401k contribution up to that overall $70,000 limit. So let's say you contribute $23,500 as an employee contribution to the solo 401k. You then make an employer contribution to the solo 401k as a profit sharing contribution at, let's say, 25% of your self-employed S corporation W-2 wages. Let's say it's 100,000 of W-2 wages. Multiply that 100,000 times 25%, which is $25,000. Add 25,000 to 23,500, you get a total of what? 48,500. You can then contribute the difference up to $70,000 as a voluntary after-tax solo 401k contribution. So let's say $70,000 minus that 23,500 employee contribution. Let me do a calculation here. Minus 23,500 minus that 25,000 of profit sharing contributions to the solo 401k. The difference is $21,500. You can contribute $21,500 as a voluntary after-tax solo 401k contribution and then convert that over to the Roth Solo 401k or the Roth IRA as part of the Mega Backdoor Roth Solo 401k. And again, this is an example of maximizing 457B contributions and then also maximizing solo 401k contributions. So again, it's very advantageous to contribute to a 457B plan as well as a solo 401k plan. All right. Looks like we got another question here. I'll be working with a certified financial planner and tax strategist. What plan documents from my solo 401k can I give them to get up to speed? Well, first you would set up a solo 401k for my solo 401k financial because we need to draft those plan documents, which come with the IRS determination letter for the plan. And then once those are drafted, then we'll get the tax ID number for the 401k. And then you can work with your financial advisor and opening the solo 401k holding accounts at the brokerage that your financial advisor clears through. Good question. All right, we got another question here. Is there an additional cost for Mega Backdoor Roth Solo? I already have you as my administrator for non-prototype solo 401k at Fidelity. Additionally, my CPA said I need to open a Roth plan and contribute to that. How do I do that? So yes, the solo 401k plan for my solo 401k financial already allows for the Mega Backdoor Roth Solo 401k strategy. If you don't have the brokerage account opened yet to hold those voluntary after-tax solo 401k funds, go ahead and submit a support ticket through our website, and we'll go ahead and shepherd you on how to get that brokerage account open at Fidelity to hold those voluntary after-tax solo 401k funds so that they can then be converted to the Roth Solo 401k or the Roth IRA. And the solo 401k that we offer already allows for Roth Solo 401k contributions as well. If you're talking about opening a Roth IRA, yes, you can open up a Roth IRA. We don't offer Roth IRAs, but you can open that up. And then whether you can contribute to that Roth IRA really comes down to the Roth IRA regulations. For example, if your modified adjusted gross income is too high, You may not be able to contribute to that Roth IRA. However, you could do what's called a backdoor Roth IRA, where you can make a non-deductible IRA contribution, which is $7,000 for tax year 2025, and then immediately convert it to the Roth IRA. But if you also have other traditional IRAs or SEP IRAs or simple IRAs, you need to be aware of those aggregation rules when doing the backdoor Roth IRA strategy. Don't confuse that backdoor Roth IRA strategy with the make a backdoor Roth solo 401k strategy. They're completely different and they have different regulations. Let me send over a link to our support system where you can submit a support ticket regarding those brokerage accounts. All right, let's see if we have any other questions here, and then we'll pick up where we left off. Today's topic is, can I contribute to a 401k and a solo 401k in the same year? Oh, thank you for the feedback. Yeah, we go live every day and we answer questions live on the air, and we appreciate the feedback there. Yeah, we appreciate that you've been watching for years. Again, we go live at least once a day, oftentimes twice a day. We like to do 2 a days, kind of like football season. Okay, give me a moment here. It looks like we got a question here from Barry. If I contribute to after-tax account at Schwab with my solo 401k financial and my Roth IRA is with the firm that is not at Charles Schwab, how can my solo 401k financial facilitate that transfer? So if you are making voluntary after-tax solo 401k contributions to the solo 401k and you're using Charles Schwab for the brokerage account for the solo 401k offered by my solo 401k financial, let us know which financial institution you are going to convert those voluntary after-tax solo 401k funds to. In other words, the financial institution where you have the Roth IRA, because it's still going to require the same type of reporting where you'll complete our online conversion form once you convert those funds so that we collect the necessary information to issue the Form 1099-R to the IRS to report that mega backdoor Roth solo 401k strategy. But as far as moving the funds, the logistics of moving the funds to a Roth IRA outside of Schwab, it just depends on the institution where those Roth IRA funds are going to be held at. Because the voluntary after-tax solo 401k funds will get converted to that Roth IRA at the outside institution. You would be able to wire those funds out, for instance, to that financial institution, and Schwab would provide a wire directive. Or if you have a checkbook, because the brokerage account, the Schwab brokerage accounts, just like the Fidelity brokerage accounts for the solo 401k that we offer, come with a checkbook. You could write the check from that voluntary after-tax solo 401k made payable to the IRA custodian and then send that check to the IRA custodian for deposit into that Roth IRA. Send us an email if you have more questions on that and we'll walk you through it. All right, looks like Alfonso has a question. What is a non-prototype solo 401k? So there's no such thing as a non-prototype solo 401k. Fidelity refers to their brokerage account as a non-prototype brokerage account for solo 401ks offered by a company like my solo 401k financial. That's a way of Fidelity saying, hey, you do not have a solo 401k with Fidelity. You have a solo 401k with my solo 401k financial, but you're using Fidelity to hold those funds inside a brokerage account for the solo 401k offered by my solo 401k financial. All right, looks like another question here. What is the current interest I can charge a residential loan for 30 years from my solo 401k? Looks like you're asking about processing a participant loan from your solo 401k, known as a solo 401k loan. So one, the loan documents have to be drafted pursuant to the IRS regulations, and we'll draft those loan documents, and that's covered in our annual fee. We don't charge extra for drafting the loan documents. Second, if you want to borrow for 30 years, those borrowed proceeds from the solo 401k participant loan have to be used towards the purchase of your primary residence. So if you're going to use the proceeds for anything else than your primary residence purchase, then towards the purchase of your primary residence, then it's only a 5-year term. With regards to the rate that's used, the interest rate, that's calculated using the prime rate plus 1%, so whatever the prime rate is now. Another option is to use a competitive CD rate and then add 2% to that, and that would be the rate, the loan interest rate on that 401k participant loan. All right, great questions. Let's see. I don't see any other questions for now. Let's finish up on our topic for today, and then we'll be back live again tomorrow. So again, today's topic is, can I contribute to a 401k and a solo 401k plan in the same year? We've been talking about this topic in great length. We've gone over several examples. We've also talked about how the rules work when you contribute to a 403b at your daytime employer and then a solo 401k. We talked about how it's not as advantageous from a contribution perspective as it is if you contribute to a full-time employer 401k and then also a solo 401k plan. We talked about how the 457b, if you contribute to a 457b, that's not going to impact the contributions you make to your solo 401k, even if you've already maximized your contributions to that 457b. Okay, let's see here. So let's talk about some common IRS pitfalls to avoid when you contribute to both. And we've kind of talked about this already by talking about the differences and giving some live examples. But common pitfalls to avoid when you want to contribute to both your daytime employer 401k and your solo 401k are as follows. Number one, make sure that you understand that in order to contribute to a solo 401k plan, you have to have earned income from your self-employed business. In other words, you cannot contribute to that solo 401k plan based on your W-2 wages from your daytime employer 401 from your daytime employer. You can only contribute to the solo 401k, just like you can only contribute to your daytime employer 401k from income earned from the business that sponsors that plan. So if you're not going to have enough net self-employment income from your self-employed business to contribute to that solo 401k, then you're not going to be able to contribute to that plan, to that solo 401k plan, because you cannot piggyback off of your daytime employer W-2 wages and vice versa. Second, make sure that you qualify to open a solo 401k plan. In order to open a solo 401k plan, you have to be self-employed, and you cannot employ any non-owner full-time W-2 employees in your business who work 1,000 hours or more in your business. So it's only for owner-only businesses and their spouses. So if your spouse also works in your business, then he or she can also participate in the same solo 401k plan. So those are pitfalls to avoid. Other pitfalls to avoid is, let's say you go ahead and contribute to your solo 401k plan, and later on you find out that you also contributed to your daytime employer 401k, and based on the type of contribution you made, you did not qualify to make those contributions to that solo 401k. Now you're going to have what's called an excess contribution. And the rules for removing excess contributions are very different depending on the type of contribution. So make sure you understand the importance of making sure that you know what your income is and what the contribution limits are and how they work when you're contributing to your daytime employer 401k as well as your solo 401k, so that you don't run into excess contribution issues. Okay, so great questions on that. As far as that's correct. The maximum solo 401k balance is 50% of your solo 401k balance. So the solo 401k loan would be $50,000. If the solo 401k balance is over $100,000, the maximum you can borrow is $50,000. Let's say the value of that solo 401k plan is $50,000. The maximum you can borrow would be $25,000 because it's 50% of your solo 401k balance, not to exceed that amount. All right, again, thank you for joining today's daily webinar. We'll be back live again tomorrow. Until next time, have a great rest of the day.